We got that CapEx guide. Arun, we're talking about $200 billion. It's a number that's hard, I think, to get your head around, Arun. You got a strong buy on this name. We're down here a quick 10% in the after hours. Give me your take, Arun, your first impressions on the print and the forecast.
Yeah, thanks for having me. Yeah, no, I mean, overall, I think the one big positive here is that AWS acceleration. We wanted to see acceleration. We got that last quarter. We saw further acceleration this quarter. We got 24%. I think the street was looking for around 21, 22%. So that was a big highlight there. Yeah, I think the shares are down because of that CapEx number. We were estimating around 140 billion in CapEx this year. It looks like it could be around 200 billion. That's much higher than our estimate, much higher than street estimates. But given what Google said last night, it shouldn't be that much of a surprise that the CapEx figure is above consensus. But yeah, 200 billion is quite a lot. I think it's about a 50% increase from 2025, and 2025 was about a 60% increase from 2024. So some significant spending ahead. But clearly, I think Amazon is still seeing more demand than it has available supply, and that's why we're seeing them, not just Amazon, but all the hyperscalers invest so aggressively to capture all this AI demand.
Dan, I want to bring in you here. Let's stick on that same thing and let's remind viewers. Amazon is calling for 2026 CapEx of about $200 billion. To Arun's point, that is far above what analysts had penciled in. Consensus was more like 146 billion. I think investors look at that, Dan, they say, okay, I want to know, I'm going to get some very strong ROI on all that spend looking ahead. Are you certain you'll get that, Dan?
I'm incredibly certain that that's coming. Look, these are very smart companies that have very good data, very good analytics, very good understanding of their demand. And basically, Josh, every CapEx estimate that's come from analysts over the last few years has underestimated what is required. Right now, Google, Microsoft, Amazon, Meta, they are all competing for the most compute. The compute is going to be the moat in terms of these companies being able to sustain their market advantages over the long term. Each of these companies understands that if they don't have enough compute, they will not be able to pivot quickly enough to the next thing. We're watching how fast new models, new services, new capabilities are hitting with AI. And of course, all of these companies are also servicing the demand of all their customers that need and want more and more compute. I saw Matt Garman this week at the Cisco AI Summit, and I listened to him talk about how the A100, that's like a 4-generation old GPU from NVIDIA, is still at 100% demand. They have not decommissioned any, and they have not seen demand go down, and they've seen the spot prices continue to go up. So the demand for this stuff remains high. These companies need it for their moats, and Amazon got it wrong in the beginning. They underspent. They understand they cannot do that again, and the street is being maybe rational in some short-term perspective of how much these companies should spend, but they're being irrational long-term if they want to see Amazon continue to do what it does and protect its moat.
So Arun, as a financial analyst then, you're looking at, all right, this call for 200 billion. What are the signs? What are the signals? What are the metrics, Arun, you're going to watch to see whether this is money that's being well spent?
Well, I mean, first and foremost, we're going to need to see AWS growth further accelerate. I think now, given that they've spent a significant amount this past year, now 200 billion in 2026, street estimates for AWS growth is probably going to increase for 2026. That's number one. Number two, we're going to look at the AWS margin line, to really see if that they're getting that ROI, and that near term there are some headwinds to margins when you're significantly ramping spending like that. But so far AWS margins have been pretty solid. I don't have it for this latest quarter, but it's been hovering around the mid 30% range, which is still pretty solid numbers. And over time, that AWS margin line could go above 40%. So we'll look to see if that how they can preserve that margin line at AWS for 2026.
Dan, I got to ask you, if I'm an investor, I'm watching this, tech pro that you are. I just heard Alphabet, all right? I just heard Sundar Pichai tell me he's going to spend as much as 185 billion. Now I got Jassy telling me about 200 billion. If I'm an investor, who downstream from this, Dan, benefits? Should I be looking at, am I looking at NVIDIA? Am I looking at Hock Tan and his crew over at Broadcom, Dan? What do you see?
Look, every part of the silicon supply chain is constrained. And right now, this should be sending signals if you want to penalize the hyperscalers for their near-term spending because you're concerned about margin pressures and you're concerned about the potential impact to their business, that's one thing. But you can tell there's some indiscriminate selling going on. Now, I think some of the semiconductors held up a little better today, but if you look at this CapEx commit, if you look at Sundar, you look at Satya, you look at Andy here, all of them are basically saying we're going to be spending big on NVIDIA. Of course, they're going to be building their own silicon, so that's great for Broadcom. I talked to Lip Bhutan the other day. He and I had an agreement on the memory. We're talking 28, 29 before those constraints lift. So Sanjay Mehrotra and the team over at Micron should be feeling very optimistic, as well as the rest of the memory, ecosystem. And then, of course, you have all the other parts, the packaging, the semiconductor equipment manufacturers, TSMC. I mean, you saw their numbers in their guide. There really is no slowdown in the spending. This is definitely an indication that the market wants to hear more clarity on where the ROI is going to come from. But clearly, these companies don't care. What they care about is they do not want to be outbuilt. And Amazon, Josh, and I'll leave you here on this, but Amazon knows this better than any, because Adam Selipsky's job was basically to get this right when he didn't get enough NVIDIA into AWS early enough. I think that's what ended up costing him his job. I think the fact they've been able to stand up Rainier, expand their capacity, and accelerate their growth to 24%, because they're facing 39% from Azure, 47, 48% from Google. They have to grow faster. They need more capacity. They have to spend.
Arun, you don't just have a buy on this name. You got a strong buy, my friend. You got a pound the table buy. When your clients ask you, Arun, okay, you're bulled up on this name, but what are the risks I need to think about, Arun? What were you telling them?
Yeah, I mean, the risk is really the elevated street consensus forecast. There are high forecasts here, and Amazon has to hit them every single quarter. I think Amazon also, they kind of shoot themselves in the foot a little bit because they report typically last out of all the hyperscalers, so sometimes a little bit more expectation there. But we still have a strong buy rating. Amazon, we talk a lot about AWS today, but both their retail business as well as their advertising business are both also firing on all cylinders here. And I think the best, the strong buy opinion is really predicated on Amazon's margin trajectory. Its highest margin businesses, namely its advertising business, AWS, is growing at a much faster rate than the e-commerce or retail side of the business. So that, I think, over the long term, over the next 5 to 10 years, we could see some significant operating margin expansion at Amazon. And they're close, I think within 5 to 10 years, they're going to be above $1 trillion in annual revenue as well. So that's some significant earnings potential for this company that, we still think trades at a relatively low or attractive valuation.
Dan, in the great AI trade and trend, there is this perception that Amazon is playing catch up, that it's chasing rivals, Dan, like an Alphabet. Is that perception fair, Dan, in your opinion? Is it accurate?
I think early on, and that's what I was talking about, I think they came out a little slow. They were leaning on their own infrastructure early before it was ready. They've made a ton of progress with Trainium. I think, of course, we're seeing this surging demand, and they got their NVIDIA capacity, scaled up. So they're moving in the right direction. We certainly saw a pivot in Cloud Era 1.0. Amazon, AWS was the largest by far. In Cloud Era 2, you can argue Azure, and especially Google Cloud has been able to really build its own infrastructure. It's spent a decade on building capacity models, chips, and so I think they're playing catch up. But I think they're showing now the positivity of that massive base of business they had from the first compute era. As all these enterprises that rely on AWS are now starting to move to AI capabilities in AWS's cloud. This number's good. I mean, 24% from a very large base. Now, having said that, the expectations remain very high. And I will also say that Amazon is probably one of the largest potential beneficiaries of AI within their own business, and not just their cloud business, their advertising business, just like Meta takes advantage of, and of course their commerce business. They have robotics, they have physical AI at the edge, they have autonomous delivery. They have so much opportunity to pull margin out of that near $1 trillion of revenue we're going to see from them in the future, that I think that's part of the story that's being missed. And finally, for all the boomers out there that are, rotating into consumer staples and nervily moving out of tech, they've got a great play, because who doesn't have Amazon delivering at their door just about every day?
Dan, Arun, so good to have both you guys on the show today. Appreciate that instant analysis, fellas. Thank you.
You got a buy rating still on this stock, Angelo, but there was a lot of disappointment here, particularly in the company's bread and butter smartphone business, which is under pressure because of the inability to get memory chips into these phones. So, this really seems to be a big challenge for the industry overall. How bad is it, do you think, and how long is it going to last?
Yeah, Julie. So, thanks for having me. It's pretty bad right now, right? I mean, you kind of look at how constrained we are. I mean, you kind of laid it out nicely, but you think about where all that memory demand is going right now. Look no further than Alphabet's results last night and the boost in CapEx plans, right? That's really the issue at hand right now. It's the fact that you're getting all this memory capacity really kind of devoted to the data center AI infrastructure builds. And as a result, if you're on the PC or the smartphone side of things, you're getting hit really hard. When you look at what's happening with Qualcomm here on a sequential basis, you're looking at handsets dropping north of 20%. Let's call it about nearly 13 to 15% on a year-over-year basis in terms of decline. The good thing is we've now seen this reset on the expectations, and you kind of look ahead. It's probably likely going to remain pretty weak here. We'd say over the next 6 to 8 quarters at least, as far as the memory bottlenecks are concerned, before you really get any notable help. And again, that's gonna hurt Qualcomm, especially given that they do have a lot of business at the low end of the channel, where a lot of those pressures are being felt. On top of that, they are losing ongoing Apple business, which continues to wind down. So they're hitting it all over the place in their core business. The good thing is they are diversifying, and that really is the core story here. If you are a bull, you're getting a very value, cheap play here with a long-term trajectory in terms of new emerging markets.
I guess the question is how long term? Like, how long do you have to wait, Angela? Because if you look at those other sources of revenue, right, which have been growing quickly, and that has been the company's whole strategy. For example, the automotive business, $1.1 billion in revenue in the quarter, so it broke above $1 billion for the first time. But phone revenue is almost $8 billion. So, you put all those non-phone things together, how long is it going to take for it to ramp up?
Yeah, it's a great question. And what I would say here is, listen, the bad thing about being a value investor or looking at value names in the tech space is sometimes it takes longer than you want to wait, right? And as far as Qualcomm is concerned, what we've told investors is you have to be patient with this. I will say this, last quarter, let's call it about 25, 26% of their revenue within kind of their manufacturing, chip-related manufacturing business came from non-handset revenue. Given the plunge that we're seeing here in handsets this quarter, let's call it about 35% or so of their revenue will come outside of handsets. And we do think within the next 2 to 3 years, that number grows to at least 50%. So on the top line, you may not see much growth there. Not to mention there is potential upside to our expectations. For instance, they are getting in areas like data centers, where if they were to announce some big customer wins, that could provide upside, right, to expectations. So I'd say at this point in time, the valuation plus the fact that, hey, listen, there is line of sight here over the next couple of years. And I know, listen, nobody wants to be talking about 6G because that's towards the end of the decade, but that's also another opportunity for the company long term. So there are opportunities out there, especially when you look at the valuation. You've got to be patient if you're an investor.
So I am curious then, Angela, if you're looking at Qualcomm versus some of the other chip makers, particularly say a Broadcom right now, yes, obviously you're saying you want to own this name, but is there other stuff where you're seeing maybe more opportunity in the short to medium term?
Yeah, I mean, listen, I think, this is a really interesting market right now. I mean, I think you kind of started off talking about some of these software names, and, there are other type of names, that we have really been punished here over the last couple of weeks within the tech arena. And I think the concern really is kind of what does the tail look like in a new AI-induced environment? Not necessarily what's going to happen in 2026, because the earnings trajectory looks pretty good for tech in this year. It's more along the lines of what's going to happen, beyond 2027. And when we start looking at maybe some of the tails with the companies within semis that may have a longer tail, I would look at a name like an AMD that just got punished here yesterday. I know it continues to be beaten down here, but it's a name that we think will turn around and has some really good opportunities tied to them as they start getting into these large-scale rack solutions. I do understand the fact that, hey, listen, can some of this CapEx momentum be sustained and maybe avoid, some of these other AI type plays? But AMD is one where I think you can get that AI play and maybe, that long tail tied to it.
Angela, you also cover Alphabet, so I got to ask you about that one because there too we are seeing some selling pressure. How much of it is what we heard from Alphabet? How much of it is the concerns you alluded to, right? The bigger concerns that seem to be plaguing tech right now.
I think for Alphabet, listen, it just had an insane run here going into the print. It's trading at about a 25% premium to Microsoft, so you've got that, going against them. Not to mention, on top of that, that CapEx number was absolutely monstrous. They're essentially pointing to a doubling here year over year. That's going to really destroy the free cash flow expectations here over the next couple of years. So essentially, virtually most of the cash from operations at this point in time being reinvested in that business. So don't expect, any significant buybacks if you're an investor in this name. But that said, listen, that backlog growth that we're seeing from Alphabet really kind of warrants higher spending. So we'll see how this all plays out here over the next couple of years. But if they make do in terms of their promises from this higher spend, there's a really great growth story here to be looking at over the next 2 to 3 years.
Angelo, in general, do you think that this sell-off that we've seen more recently in tech is really giving a gift to investors who want to add to positions or enter positions?
I think a market like this gets very dangerous in the sense that, it's not necessary. You're not necessarily seeing the pullback here due to some adjustment factor in terms of earnings. It is, again, that long-term unknown as far as we kind of transition to this AI world. What I would tell investors, and I think what most people would agree with, is you do have to be a lot more selective in this type of environment. You do have to look at names that say, hey, listen, where are stories that can continue to grow in an environment here 3, 4, 5 years down the road, where we do have high conviction. A name like Alphabet is a great example of that, where maybe some of these SaaS-oriented names, get a little bit more difficult. So I do think there are some value traps in this market. I think there are also some great opportunities.
And you just named at least one of them, a couple of them for us. Angelo, thank you so much. Good to see you.
All right, thanks, Simon.
It was the low from last year, that's 2025. It was also the high from 2024. And so that was kind of my line in the sand. And I said, if it starts kind of probing below that level and then it acts as a resistance, here's a chart. Let's just put the 5-year up there.
Oh, well, hold on. This is the bind.
Oh, good catch there. Let's put Bitcoin, because they do look kind of similar here. And let me just take it down to a 3-year. So as I was saying, we got the highs of 2024, we got the lows of 2025, and now we are below them, and solidly so. It's not even close. So what I said is that's probably crypto winter. And the beginning of it was actually up here, although we didn't know it at the time. And I keep hearing analysts talk, incredible analysts, about the 4-year cycle. And I know you've talked, and you've read the same 10X research here.
Yes, exactly. So 10X research, you and I both read the report this morning, and they're talking about a potential low of 40.
Yes.
And they say that's not going to happen in the short term. They're looking more towards sort of September. FIFA, I think the World Cup is like their peg for it.
I looked that up. So that's mid-June to mid-July. And so that would be the beginning of the window. And I think September would be the end of the window. So we've seen this cycle play out before. Let me put a 10-year chart so I can show you what happened over the last crypto winter. So here we had 20 to 2022. We had this double peak here. And then it took a while to find a bottom. We eventually did. But then it's off to the races. Here we have a little bit of a different structure here, but a double peak. And it looks like, if you extend this line, we'll have that bottom maybe sometime in the fall, or maybe as early as summer. But I was talking to Mark Newton on an episode of Stocks in Translation. He's the top technical strategist for Tom Lee, and specifically mentioned the 4-year cycle, which I thought was interesting. And let's take a listen to that.
I don't sense it would go down 80%. Personally, I think it's going to be capped. I think Bitcoin, in my own view, goes to 60, between probably 60. High 50s, 60. I don't think it's going to be a straight shot.
So he's not quite as pessimistic.
Well, he did say it could dip into the 40s. So I'm not hearing anything about an 80% wipeout. So I guess that's the good news. And the other good news is that Bitcoin is very cyclical. We've seen these cycles play out before. And so you just got to kind of hold yourself right here if you're a holder, or if you want to buy, just wait a little bit.
Well, what I thought was really interesting about that 10X research report is the whole industry. I mean, you and I have been talking to people in the crypto industry for a while. They were so excited about institutional adoption. It's going to become more normal for people to hold Bitcoin. Well, guess what? That's a double-edged sword, because when it starts going down, those institutions are not necessarily willing to step in there because we don't know how much more it's going to go down.
Right.
And they are buying and selling in more size than a retail investor.
I think the bottom line too is we need kind of a new catalyst. Web3 was, it's kind of petered out, and I've looked into the venture capitalist markets. They're not able to fund projects the way they were in the past. They're just not attracting investor capital. So there needs to be a new thesis here, some kind of, maybe the technology hasn't even been invented yet. Maybe it integrates with AI in some way, but the old paradigm is kind of dead here. 2025, the most bullish year in terms of financial regulation for Bitcoin ever, and we didn't really see that much.
Well, and that suggests that the Clarity Act, which the industry is now pushing, including and sort of led by Coinbase's Brian Armstrong, which will clarify more of the pipes and the regulation around crypto, that suggests that even if that does get through, it might not be a very long-term catalyst.
No, I think we need new tech. That has to be the catalyst here, but that's just my personal opinion.
We'll see if it happens.
All right.
Thanks, Jared.
Thank you.
Good stuff. And you can find crypto predictions and much more by going to the Yahoo Finance Predictions Market Hub, powered by Polymarket. Aaron, glad to have you back on the program, especially after seeing a quarter like that. Thanks for being here.
Well, thanks for having me. You know, momentum is really the Cardinal Health story today. As you pointed out, we released a strong set of earnings this morning and raised our guidance again. We've been blessed to see strong operating profit growth across all 5 of our operating segments, and that's really being driven by 2 things. One, strong demand really across the healthcare ecosystem that our business serves. We're really the beginning, the middle, and the end of the healthcare system, and so we're seeing that strong demand, and that's been matched by the Cardinal team and really strong execution in support of that demand, and so we're really pleased with the results for the quarter.
Aaron, talk to me about specifically what gave you the confidence to raise that forecast for the second time in 2 months. You said you're seeing strong demand. Where is that strong demand coming from specifically?
Yeah, we are seeing strong demand across the portfolio. Our largest business is our pharma and specialty services and solutions business, which is a combination of the old school distribution of pharmaceuticals, as well as the MSOs, as well as specialty distribution, as well as biopharma services. And so we're really seeing patients leaning in, getting the healthcare they need, doctors prescribing the pharmaceuticals that they need, and the services that we're increasingly providing really being in demand. So that has certainly helped. We have 3 businesses which we affectionately call other growth. Our nuclear precision health business, our OptiFreight logistics business, our direct shipment to the home business, and for healthcare services and supplies as well. All those are seeing very strong demand as well.
It's interesting, Aaron, when you talk about people taking advantage of their, taking control of their health, using more of this stuff. It's interesting because it's a little bit of a double-edged sword. If you look at many of the health insurance companies, they're spending more, right? Because people are spending more on this kind of health care. And I wonder what kind of visibility you have in how long that it will last. It's something that is, I think we can safely say, has confounded the health insurance companies a little bit, even as it's been good for you guys. How long is this trend going to last?
Well, there's an underlying factor that we have to keep in mind, which is the demographics are not changing, and that the American consumer, the American patient is getting older. And as people get older, they need more help. They are leaning into their health care. And so as we see the aging of the American population, we expect that the positive demographic trends will continue. Look, at the end of the day, it's not all about cost though as well, because if people are getting the health care they need, if they are adhering to the healthcare regimen that their doctors are prescribing, that should bring costs down, not up, because they're avoiding the secondary and tertiary treatments then.
Aaron, I'm curious, do you see the policies of this administration as more of a headwind or a tailwind at this point? Because I can think of 2 things that could potentially hurt demand. One of them is that maybe more people are paying out of pocket if they went off the Affordable Care Act, as we saw some changes in those subsidies. And the other, of course, is this announced Medicare reimbursement rate that is not as high as had been anticipated. That's more going forward. Are those going to reduce demand at all for you, or people paying more out of pocket?
Yeah, there's a couple things that we are in total alignment with the administration and Congress on, which is we are in favor of access, right? We are in favor of affordability. We are in favor of innovation. What that looks like will depend on the channel, will depend on the therapy area, will depend on the full ecosystem of healthcare. But what we are in support of, and certainly how we're talking to the administration, is how do we drive those three things? You got to keep in mind that Cardinal's role in the industry is as we efficiently and securely and safely move goods and provide services to the broader healthcare ecosystem. And we can do that in support of the goals that are out there.
And what about on the front of people not getting those ACA subsidies, for example? Are you seeing that filter through anywhere in your business?
Yeah, we have not seen a decline in demand, right, as a result of that. And indeed, with each change that has come through in the last couple of quarters, the question to us has been, well, is this going to cause people to change their behaviors? Perhaps, but we aren't seeing signs of that as yet.
Aaron, I'm also curious about the tariffs, right? Because you guys have talked about tariff pressures. You talked about it again in this quarter. What kind of pricing power do you have on the other side? Are you all raising prices to try to offset some of those increased tariff costs?
Yeah. Well, particularly with respect to our medical products business, what we call GMPD, right? We've been very transparent now for a couple of quarters that while we will lean in and drive operating efficiency and wherever we can avoid taking price, with the face of tariffs with tariffs coming through, we will need to share some of those costs with our customers. And we have actually raised prices in key parts of our portfolio over time, just reflecting the realities of where we are.
I'm also curious. I'm asking about all the buzzy things. So let's talk about GLP-1s, which is what could be buzzier than that. I know that you guys saw some increases in revenue and profit tied to that. Talk me through that, and especially given that there are a lot of affordability programs for those types of medications, the prices are coming down. How you're seeing that filter through?
Yeah, our revenue grew by 19% in the quarter within our pharma business, and about 6 percentage points of that growth was actually tied to GLP-1s. Now, I get a lot of questions around, well, what about the oral solids? What's that going to do from a growth perspective or an affordability perspective? And it's too early to tell. We are shipping the oral solids from a GLP-1 perspective within the industry. And thus far, we haven't seen it change demand, right? We haven't seen it cannibalize the injection versus the oral solids. And so the key question will be, what do the manufacturers do from a pricing perspective? What are the access points? Is it only through the pharmacies? Are there direct-to-consumer channels? This goes back to what I was saying earlier, whereas we're in favor of access, right? There is a distributor behind virtually all of the various channels here, whether it's direct-to-consumer or the more traditional pharmacy as well. And so we're going to enable the access. We're going to ship it as efficiently as we can. And we're also in support of the innovation that the manufacturers are bringing, because ultimately we think that also enables both access and affordability.
And one more GLP-1 related question. Part of the promise, of course, is GLP-1s is that it will help people lose weight and help them be healthier so that they won't have other sort of comorbidities and other health problems that come from obesity. Are you seeing that filter through yet? Are you seeing a decrease in demand for those other things? And on what timeline would you expect that to maybe happen?
Yeah, we have not seen an increase in demand on chronic conditions, which I think is what you're asking. But there are some corollary benefits in our portfolio. We're one of the largest distributors of CGM devices, for instance, right? And you might say, well, why do you need a CGM device if you're losing weight and you're not diabetic, right? Well, the good news is that the American patient, as they're taking better care of themselves, right, they are both going on GLP-1s and losing some weight and monitoring their health more carefully, which means that our business in support of diabetes and CGMs is also growing.
Gotcha. Interesting. And we're continuous glucose monitors for those who are not familiar with the acronym out there. Aaron, always great to catch up with you. Thanks a lot for your time today.
Thank you.
Take us through the Express Scripts business. You're going through that earnings report for Cigna today. That was a big driver for you. What are some of the drivers in that business right now?
Yeah, thanks so much for hosting us here this morning, Brian. We were pleased to report a really strong quarter in the fourth quarter with our earnings per share a bit ahead of expectations. Strength across both our Cigna Healthcare growth platform as well as our Evernorth growth platform. And the specialty pharmacy business within Evernorth was a particularly strong driver within the quarter. You asked about Express Scripts, which is our pharmacy benefit services business. That continued to perform well in the fourth quarter. And it's going through a significant amount of industry transformation, as evidenced by the new product we introduced last October, which puts patients at the center. And I'm happy to talk further about that if interesting to you.
Yeah, this is there's been some legislation this week that is directly likely to directly impact that PBM or pharmacy benefit manager business model. What does it mean to the bottom line of your company?
So you're right. There was a landmark piece of legislation yesterday, and we agreed with the FTC, importantly, to put some legacy matters behind us and move our company forward to help transform the patient experience, specifically around pharmacy benefits. And we were thrilled to see the administration come out in support of our agreement that we announced with the FTC yesterday, saying that this puts Americans first around pharmacy benefits. And really, this builds off the innovation we introduced last October, which is a new rebate-free pharmacy benefits model where patients are guaranteed the lowest possible prescription drug cost when they go to fill a drug. So whether that's the price we've negotiated with drug companies or an alternative cash pay price or their copay, whatever the lowest possible price is, we guarantee patients will get that. So it gives them the peace of mind that they're getting good value for their money. And so the additional regulations that came through this week are very much aligned to that goal of improving the patient experience and driving better value for the patients we serve.
Brian, ahead of this, I was thinking back to when I started my career, I was a stock analyst, and one of the first couple industries that I covered were the PBM industries, and as luck would have it, Express Scripts. And this industry has always been looked upon as doing bad for healthcare. And that vibe still consists today. I mean, how do you respond to this ongoing criticism of what y'all do?
Healthcare is a really complicated industry, and I appreciate that question because we get different flavors or versions of that frequently. I think it's important to step back and think about what are the drivers of the healthcare affordability challenge that we have in America right now. And I like to use just a basic demand and supply framework for that. We have increasing demand for drugs, increasing demand for medical services that comes from the aging of the population, and it comes from more and more people who have chronic conditions. So in fact, 85% of all the healthcare spending in America is associated with chronic conditions. So there's this insatiable demand dynamic that's transpiring in America. On the other side of the ledger is supply. So in most industries, when new supply is introduced, the prices come down. In healthcare, that's not the case. So if you look at hospital prices are up 220% since the turn of the century for an average hospital stay, far higher than inflation. Additionally, when new drugs are brought to market, well, often they're curative and they're great for society in total. The price of them is astronomical in some instances. So just last year, the median list price of new drugs that was approved was $370,000, which is far out of reach for most Americans. So you have this insatiable demand dynamic pushing up, and the price of supply continues to push up. So we play this important role in the middle to serve as a counterweight to those forces. But by definition of that, we're negotiating with the supply side and we're engaging with the demand side in a way that's trying to drive people to lower cost alternatives, because ultimately that's our goal. That's the mission of the Cigna Group, is to help people have more affordable health care and to improve their health and vitality going forward.
The Trump administration has really focused, Brian, this year on bringing down drug costs. When will the average household start to see these lower costs, and do you think it will be noticeable?
We share the goal of the Trump administration to bring down prescription drug costs. Affordability is the number one challenge in American healthcare. So we share the strategic intent of that. And importantly, some of the innovations that we've brought forth, even in recent months, directly speak to that. So a good example is late last year, we announced a partnership with EMD Serrano to bring fertility drugs to Americans at a much more discounted price compared to what they were able to get historically. That'll be available through the Trump RX platform that'll be coming online in the coming months.
Well, good luck in the coming quarters. Looking forward to talking to you again soon. Brian Ivanko, I'll talk to you later. Appreciate it.
Thanks for your time, Brian.
Well, U.S. futures are lower as investors digest this week's tech sell-off. Joining us now, Angelo Korkafis. He's a senior global investment strategist at Edward Jones. Angelo, we have seen this tech sell-off, and we have also seen a rotation into lots of other stuff, sort of cyclicals, old economy kind of names. Do you expect that sort of movement to continue? Do you think tech will continue to be under pressure?
Yeah, I think rotation remains a dominant theme for markets this year as we think about investors rotating into what I would call old economy sectors and stocks, whether that is transports, regional banks, chemicals, oil and gas. And I think there is a good reason for that. And this week's rise in PMI, looking at manufacturing activity, expanded at the fastest pace in over 3 years. So there is hope that we're seeing a turn in the industrial cycle after a long period of stagnation. I think that provides some promise. And this is happening at the same time as the momentum moves away from some of the more growthy, speculative parts of the market. So I think this is a healthy development and potentially has some legs.
Well, I guess, Angelo, the problem is it's a healthy development, maybe, but like the market can't rally without tech, I guess is the issue. I mean, there was a note that Julian Emanuel over at Evercore ISI came out with that pointed that out, that we've got between tech, communication services, and consumer discretionary, which has Amazon in it, that's 54% of the S&P 500. So if that stuff is not going up, the S&P can't go up. So how do you think about, the rotation being healthy without, tech kind of has to participate, doesn't it?
Yeah, that issue of high concentration is the reason why we see the equal weighted S&P outperforming the market capitalization S&P. Small caps, mid caps are outperforming. The reason why I call it healthy is that while technology stocks continue to deliver strong earnings and results, what that has translated into is basically earnings rising faster than prices and valuations getting cheaper. It's been more than a year that the technology sector has not seen valuation expansion. So at some point, there's going to be some bargains, and technology remains one of the key drivers, really, for the earnings growth for the S&P. But now, there is an alternative, meaning that before there was no earnings growth from the rest of the market, and there is one now. I don't think this decline in technology stocks is going to be becoming something deeper necessarily, but it is a dynamic that we are watching. We have seen indiscriminate selling in software stocks. And at some point, there's going to be some winners and some losers. Not all of these software stocks are going to be disrupted by AI. It is hard to now differentiate who are going to be the winners, who the losers. So participating and looking for some bargains in a diversified way makes a lot of sense. So we don't think tech is going away, but there is some positive thrust for parts of the market that have been unloved for a long time.
I mean, they've been a lot more loved this year, at least some of those groups, right? Energy has certainly done well this year. Industrial is doing pretty well this year. Is there one or two of those groups in particular that you think is especially well poised to continue to outperform this year?
We like industrials. The industrial sector has very different end markets that are all participating in the industrial upcycle. We also like consumer discretionary. In the first half of this year, we're going to see some of the tax refunds benefit and support consumer spending. And then we also like healthcare as a sector that has been out of favor and potentially has some upside. So we're not recommending to underweight tech, but we are spreading out some of our exposures, and we see that cyclical upturn acceleration benefiting sectors like industrials.
Angela, what do you think about the sort of macro backdrop here? Because traditionally, a sector like industrials or some of the other cyclicals would be doing well because there is an expanding economy. But at the same time, yes, we saw strong GDP growth late last year, but we're in this sort of sluggish labor market. Do you think that is going to start to be reflected in growth as the year goes on?
Yeah, I think the low hiring, low firing conditions in the labor market will probably persist. But at the same time, corporate profits are rising. We are seeing above trend growth. And it's not only AI, CapEx driven, CapEx spending driven, it has been the consumer really pushing this economy higher, and that is the key reason behind the resilience. We're talking about a slowdown, no doubt a cooling in the labor market, but incomes remain supported by rising wages that outpace inflation. So even though necessarily we have seen the so-called K-shaped economy with the high-income cohorts doing a lot better and accounting for most of the spending, at the same time, we don't see any catalyst, either looking at companies that remain very profitable, they don't have necessarily a reason to really provide grand-scale layoffs, or at the same time, we have multiple levers in the economy that are starting to work, including the industrial and manufacturing side that has been in, let's call it, recession most for the past 3 years.
And then I know you, like many investors now, are looking outside of the U.S. as well, right? I mean, that trade has had a bit of a run already, but it feels like people are kind of sticking with it.
Yes, we think about one of the most lasting drivers of returns being earnings. We are seeing an earnings acceleration outside of the US, similar to the industrials here in the US, where we have seen really manufacturing sluggish environment for the past 3 years. That's been the case also abroad for other indices. And now that is starting a bit to change. The US dollar weakness has been a key driver behind the outperformance, but it's not the only one. And we are looking for a potentially range-bound to slightly weaker dollar, which should continue to benefit those international asset classes. And as we talk about tech, we still have many AI companies that are located abroad and are still part of that AI build-out story that trade at lower valuations. So I think there are some credible reasons for international diversification to really be a key part of investors' portfolios this year.
Tarang, good to see you as always. So take us through this quarter. You know, running down that earnings call that you guys had, I really think this was a road-powered quarter. What are you seeing with that brand right now?
Well, we delivered an amazing quarter. Our net sales were up 38%, our adjusted EBITDA was up 79%, and our namesake e.l.f. brand continued to grow market share, up 130 basis points. This marked our 28th consecutive quarter of both net sales and market share gains, and so we continue to have incredible momentum. And as you said, Rhode has been phenomenal. Rhode launched back in August, September in Sephora North America. It was the biggest launch they ever saw, continues to be their #1 brand. We more recently launched in Sephora UK. That launch was 5 times bigger than any other launch Sephora had ever seen. And next week, we're entering Mecca in Australia and New Zealand. So the brand has just unbelievable momentum, and we're really proud of it.
Why? Why that momentum?
Well, I think it really goes back to Hailey Bieber and her founders and the vision they had of one of everything really good. So it's an incredibly curated lineup that really ties into her lifestyle, and consumers can't get enough. I mean, I've never seen a brand that's gone from 0 to 212 million in net sales in less than 3 years, DTC only, with only 10 products. And one of the things that I noticed when we were doing our diligence on the deal is consumers will be willing to wait out for one of their pop-up events 14 hours overnight for an event Hailey's not even at. They're buying into the entire lifestyle, and obviously they're buying into the incredible quality of those products. So couldn't be more excited about the momentum we have with Hailey, but also across our entire brand. We have 4 of the fastest growing brands in color cosmetics and skincare, and e.l.f. Cosmetics, e.l.f. Skin, Naturium, a brand we acquired 2 years ago, the clinically effective biocompatible skincare brand, and obviously Rhode. So we have great momentum across our entire portfolio.
Is it part the strength in that brand, Rhode brand? Does it reflect her social media following? What does she have? 56 million followers on Instagram alone. So if she puts something out to that following, they pop up wherever those products may be?
Well, certainly that's part of it, but it goes much deeper than that. The quality of the products are just absolutely terrific. And so, there are a lot of people that have a lot of followers that haven't been able to translate that into a viable, successful business. So, I tell people all the time, Haley is certainly a celebrity, but she's one of the most thoughtful founders I've ever met. And every instinct that team has been great. And our approach on acquisitions is we bring on the entire team, we see what else they need help with, and we continue to support them. And that's been a winning formula, not only for Rode, but also for Naturium. And certainly we continue to propel our e.l.f. brands.
What does the product roadmap look like for Rode? Like 3 years from now, what categories are there in? I imagine you have to launch more categories to get value for that investment the team made.
Well, I think there's still a ton of potential in their core category of skincare. We now have 3 of the fastest growing skincare brands in Rode, Naturium, and e.l.f. Skin. So we see a lot of potential there. Rode also has these hybrid makeup products as well as accessories and lifestyle products. So the brand is very much a lifestyle brand. There are multiple categories available to it. But what I love most is just how disciplined and thoughtful the brand has been in terms of its product rollout. You do not see this proliferation of SKUs. It's a very tight lineup, and you'll continue to see that. We most recently launched a face mask and a lip mask that's off to an incredible start. So you'll see a good cadence of innovation. Certainly that's something e.l.f. is known for, but you'll also see that same level of care and discipline in terms of what we roll out.
Love me a good face mask. That is all true. I want you to react to this one, Tarang. This is a report from J.P. Morgan this morning. They said this, quote, "The much slower core business growth is concerning." How would you respond to that?
Well, I would say our core business is incredibly healthy. If you look at our consumption in color cosmetics, it was up 8%, double the category. If you look at e.l.f. Skin, it was up 16%, again, double the category. So this is just a question between shipments and consumption. Last year at this time, we had a massive rollout in Dollar General, 11,000 Dollar General doors. We also picked up 50% more space at Target. We now have 20 feet at Target. And so we're overcoming that pipeline shipment. So that's the reason why our shipments are lower than our consumption. But my experience is over time, shipments and consumption equal each other. So the more important thing is to continue to look at our strong consumption growth and market share gains. That's a better indicator for the long term.
The pace that the core business is growing coming out of this quarter, do you see that continuing into the second half of this year?
I definitely, we haven't given next year's guidance, but this has been consistent. We've grown 28 consecutive quarters with industry-leading consistent growth, and I don't see anything that would change that. We continue to build share. We continue to bring more consumers to our brands. e.l.f. is the #1 brand by far amongst Gen Z, Gen Alpha, and Millennials, and we continue to pick up more consumers. So I just see the strengths that we have in terms of our value proposition, powerhouse innovation, and disruptive marketing engine continuing.
Lastly, Tarang, I've talked to a lot of consumer CEOs this week. I have PepsiCo CEO to kick off the week, talking about affordability challenges. They're cutting prices. You just mentioned those 11,000 Dollar General doors. What are you seeing in those Dollar General doors? Are you seeing fewer trips down the cosmetics aisle because that low-income shopper is they're really under a lot of pressure?
Well, I think, the thesis for us going into Dollar General is they serve the underserved. A lot of the places their stores are in rural areas where the next store, less than 20,000 people in a particular market, 20 miles away from another store. And so our hope was that we bring the best of beauty to those consumers, and that's exactly what happened. We're the most productive brand by far that Dollar General carries. I think we brought, people who bought e.l.f. at Dollar General, 60% of them are to buying cosmetics at Dollar General. And we're also picking up a number of new consumers, and we continue to see great momentum. So I think this ability for us to bring the best of beauty with our incredible values really resonates across really all income groups.
What is the difference between a company that announces huge spending plans and the stock rises, and one that announces huge spending plans and the stock falls?
Yeah, Julia, the gap there is expectations. And so, like you referenced, at the midpoint of their CapEx guide, $180 billion, double last year, we had been forecasting $125 billion. Sell-side consensus was 115 billion. And I felt like just in our investor conversations leading into earnings, investors were around 130 billion. And so it's actually, it's a pretty big gap. And so I think investors today are digesting this guide on CapEx, but also with it, and what you just led with, this cloud revenue acceleration was massive. So you are seeing the AI demand and investments in cloud search growth accelerated. And Sundar also mentioned that there are capacity constraints still, just given the strong demand at cloud, at search, et cetera, for the strong AI demand. And so they're going to double CapEx, and they also said, like, even despite doubling CapEx this year, they're still going to be constrained entering next year. So that just gives you an idea of just how much demand there is for their AI offerings.
So it sounds like you think that maybe the sell-off is a bit of an opportunity for investors to step in, or that it's sort of misguided?
For sure. I mean, yeah, it's looking down 4 to 5% today. And to be fair, the shares are up 60% over the past year. Sure. So, for us, I mean, if you look at Alphabet, I mean, they have arguably now the leading foundation suite models with their Gemini suite of models, which is driving, kind of like I just referenced the cloud growth and all the opportunities there. And then, like, if you look at search, right, their core business, search growth accelerated by a couple points, beat street estimates. It was broad-based across verticals, across geos, and they said that AI mode and AI overviews drove record engagement at search, which is pretty historic. And if you go back over the last year, I mean, Alphabet's done an incredible job, A, with its Gemini suite of models, B, incorporating AI tools like AI mode and AI overviews into the kind of broader search umbrella, and really kind of stave off that sentiment that was out there the last couple of years of ChatGPT being a big secular risk to Google search. And so, from that perspective, we're entering the year for Google. Their businesses, search and cloud, are in really good shape. They're accelerating. So, it may take a step back today, but I think the story is over the next couple of years, still a great story.
To your point about Gemini, I thought the numbers were interesting there. That 750 million monthly active users on the Gemini app, which of course doesn't capture desktop or people going to a browser, I suppose, and using it. And then they said they had, 8 million paid users on Gemini Enterprise, which was also interesting. How do you think about Gemini as the engine for some of those other things that you were talking about, and sort of how the consumer-facing users on the app or wherever then feed into the enterprise flywheel too?
Oh yeah, no, it's the Gemini 3, Sundar was talking about it last night, how great of a model it is, and you're right, like, you're seeing it in the enterprise. Yeah, the 750 million on the consumer side, 750 million MAUs. That was up from 650 million at the third quarter. And they said engagement is also rising in the standalone Gemini app. They also called out the Apple relationship and how they're partnering there, and how this is from the enterprise perspective. Apple's going to be building their foundation models off of Gemini and off the Gemini suite of models. So it creates, when you have kind of leading tech like this, leading foundation models, it creates incredible optionality for Alphabet, both on the enterprise side and on the consumer side.
The other thing I wanted to ask you about was a comment that the CFO made on the call, that the AI agents are writing about 50% of Google's code at this point. I mean, do you anticipate a big wave of job cuts at some place like Google, if that is indeed the case, that they're just not going to need as many people to do coding there?
I don't think so. And you had some headcount growth. We're past the days of, like, right after COVID, where these companies were adding a crazy amount of employees. And I think you've seen, well, you saw it with Amazon, they're obviously cutting, but I think for Alphabet, we have modest headcount growth. And one of the benefits of this technology is the productivity gains. But if you go back to the Meta earnings last week, I think their CFO said, this was in the callback. She said, "Yeah, we're seeing productivity gains with our engineers." And someone asked if they would cut heads, and they're like, "We actually may add more. More great technical workers that are more productive can kind of drive their business." And I don't, so I don't see Alphabet with broad headcount cuts to come, but headcount growth has slowed definitely, obviously, over the last couple of years.
Right, and we got Challenger Grain Christmas numbers this morning showing lots of job cut announcements in the month of January. I wanted to ask about Waymo and its role here too. Of course, it was in the other bets part of it, right? So again, like when you think about these things that sort of seem like side businesses for Alphabet, of which it has many, how do you think about what it means to the business?
Yeah, I mean, Waymo, I think they're raising at like $110 billion valuation. It's still a really small part of the overall Alphabet valuation. But I mean, they're the leading AV tech, full stop, in the United States. They're in 6 markets now. They just launched in Miami, I think, last week. We think they're going to be in upwards of 20 markets in the US and London and perhaps even Tokyo by the end of this year. They're definitely accelerating their roadmap. And it's been a long-term investment, and that's what Alphabet does. They bet on the long term. And so over the next 5 to 10 years, Waymo is going to be increased. We're going to increasingly see Waymo, in the U.S. and outside the U.S. Definitely a part of the rideshare industry. I also cover Uber and Lyft, and then we'll see how it evolves and if it becomes if they partner with OEMs and the technology is on the autonomous technology is on vehicles that consumers can buy.
Finally, I do want to get your take, John, because obviously you're positive on Alphabet. We're seeing the shares under pressure today, but this is happening amidst the backdrop of a bigger tech sell-off, right? Yes, a lot of it's concentrated in software, but it has gone well beyond software at this point. What do you think that reflects? How far do you think it could potentially go? And what's going to regain the confidence of the market in some of these names?
Yeah, I mean, I always go back to, kind of execution. We're going to have to look at execution, and we're going to get Amazon tonight. I also think it should be good, and we're bullish. We're bullish on Amazon, but I think it would be the companies executing and proving out that there are returns for these AI investments, and work on the part of folks like myself and my peers and investors on figuring out the returns for this really historic AI infrastructure investment cycle that we're in. I don't know in the near term if the tech tape is gonna turn up, but I think you're seeing like the fundamentals for these companies are really in great shape. Obviously, we've talked about Alphabet. Meta's fundamentals are very good. And we think Amazon's are as well. We don't cover Microsoft and some of the other players, but yeah, so we'll have to see. But yeah, execute and follow their plans.